Hello again, fellow BeachBum traders. Thank you for joining us for our video on the wash sale rule for beginners, where we will go through a lot of information about what is a wash sale, how does it work, what's the purpose of the wash sale, what are the details of the wash sale rule. We'll give you the basics, help you understand the basics of a wash sale. We'll talk about, can the IRA transactions trigger a wash sale rule? Talk about how to avoid violating the wash sale rule with realizing tax losses, and how taxpayers can do a legal wash sale. And again, we'll talk about some trading strategies, etc., so you can trade, make money, succeed in your trading career without violating the wash sale rule, and also how the wash sale rule can affect your trading strategy, etc. So stick around to the end of the video. And again, we'll talk about some trading strategies around the wash sale rule, how can it affect your trading strategies, how you can make money trading without violating the wash sale rule, and also by benefiting from others relative to the wash sale rule, and also how you can do a legal wash sale. So we hope this all helps, and we'll get started.
What is a wash sale? A wash sale is a transaction in which an investor sells a losing security to claim a capital loss, and within 30 days before or after the sale you buy substantially the same securities, acquire substantially the same securities in a fully taxable trade, or acquire an option to buy substantially the same securities. Some investors attempt to use this technique to realize a tax loss without eliminating their exposure to the market in that security. There are legitimate ways to avoid the impact of the wash sale rule. The Internal Revenue Service (IRS) established the wash sale rule to discourage selling a security at a loss solely to take advantage of a tax deduction. The rule prohibits selling a security at a loss and repurchasing the same security, or one that is substantially identical, within 30 days before or after the sale, or acquiring an option to do so. The rule doesn't prohibit the sale itself, instead, it prohibits the investor from claiming the loss for tax purposes. The IRS did not define substantially similar in the rule. Thus, investors seeking to avoid a wash sale must look at various guidance provided over the years in IRS rulings and letters. One of the more helpful tests is the Facts and Circumstances test, which states that to determine whether securities are substantially similar, the investor should consider all the facts and circumstances in that particular case. According to the IRS, securities of one corporation are not substantially similar to securities of another corporation, nor are bonds or preferred stock or bonds of a corporation considered substantially similar to the common stock of that corporation. Key takeaways. A wash sale occurs when an investor sells a security at a loss and within 30 days before or after that sale purchases the same or substantially similar security. The IRS has not explicitly defined a substantially similar security. A disallowed loss is usually added to the cost basis of the repurchased security. Generally, stock of another company or an option or bond in the same company is not a substantially similar security. Some automated investment programs, like dividend reinvestments, can cause unintentional violations of the wash sale rule. Example of a wash sale: for example, an investor buys 100 shares of XYZ technology stock on November 1 for $10,000. On December 15, the value of the 100 shares has declined to $7,000. So the investor sells the entire position to realize a capital loss of $3,000 to claim a tax deduction. Then on December 25 of the same year, the investor repurchases the 100 shares of XYZ tech stock to re-establish the position in the stock. According to the wash sale rule, the loss would not be allowed, as the investor would have repurchased the security within the 30-day limit. Can you avoid the wash sale rule? There are simple techniques that investors can use to stay in the market for a particular security until the wash sale period has expired. For example, if the investor sold the 100 shares of XYZ tech stock on December 15, the investor could have purchased a technology exchange-traded fund (ETF) or tech mutual fund to retain some holdings in the technology sector. This strategy will not replicate the initial position precisely because of the different financial instruments involved. If desired, when the 30-day period passes, the investor can sell the mutual fund or ETF and once more repurchase XYZ stock. Of course, an investor can always repurchase the stocks before the expiration end of the 30-day period, but then the investor will not be able to realize a tax deduction from the initial loss. Another simple technique for avoiding the effects of the rule is to purchase additional shares of the stock and hold those shares for 31 days. At that point, the investor can sell the shares producing the highest loss and can claim that loss for tax purposes. It is important to note, however, that an investor cannot avoid the impact of the rule by buying in one account and selling in another. The rule is applied to each investor, not to each account. In other words, if an investor sells at a loss in one account and purchases the same or substantially similar security in another account within 30 days before or after the sale, the wash sale rule will apply to that transaction. Broker-dealers only report wash sales within the same account. Investors are responsible for reporting inter-account wash sales. Similarly, an investor cannot avoid the impact of the rule by having one spouse sell while the other buys. The IRS considers the two spouses as a unit and will disallow the loss. The same rule applies to a business owned by the investor. The transactions of the business and the investor will count as sales by one unit. If an investor repurchases the securities in an IRA account, not only will the loss be disallowed, but also the loss will not be added to the cost basis of the shares. It's important to remember the effects of the wash sale rule when engaging in the tax loss harvesting at year-end. Any stocks sold by December 31 for tax loss purposes cannot be repurchased until at least January 31 of the next year or the loss will be disallowed. Finally, investors cannot avoid the rule by buying and then selling at a loss within 30 days. The order in which the buy and sell occur is irrelevant to the wash sale rule. Any purchase of the same or substantially similar security within 30 days before or after the sale will make the loss ineligible for tax purposes. Wash sale penalty. A wash sale itself is not illegal. Claiming the tax loss on a wash sale is, however, illegal. The IRS does not care how many wash sales an investor makes during the year. On the other hand, it will disallow the losses on any sales made within 30 days before or after the purchase. If the IRS determines that a transaction violates the wash sale rule, it will disallow the loss deduction on the original sale. However, the loss will be added to the cost basis, the original purchase price for tax purposes, of the purchased security. The IRS also adds the sold securities holding period to the newly purchased security. There may, however, be an advantage to this penalty, in that, when eventually sold, the loss on the repurchased security may be even larger than the original loss for a greater tax advantage. Similarly, the extended holding period can turn the loss or gain from short-term to long-term. For the moment, though, the loss is disallowed on the original sale. What happens to your loss? When a loss is denied as a wash sale, the loss is added to the cost basis of the repurchased security. This means that the investor will recoup the loss if the security is again sold at a loss calculated from the higher cost basis. The bottom line: the IRS created the wash sale rule to prevent investors from selling securities for the sole purpose of claiming a tax loss while immediately repurchasing the same security. Wash sale, definition, how it works, and purpose. What is a wash sale? A wash sale is a transaction in which an investor sells or trades a security at a loss and purchases a substantially similar one 30 days before or 30 days after the sale. This is a rule enacted by the Internal Revenue Service (IRS) to prevent investors from using capital losses to their advantage at tax time. The rule applies to stocks, contracts, options, and all other types of securities and trading. Key takeaways: a wash sale occurs when an investor purchases a security 30 days before or 30 days after selling an identical or similar security. The IRS instituted the wash sale rule to prevent taxpayers from using the practice to reduce their tax liability. Investors who sell a security at a loss cannot claim it if they have purchased the same or a similar security within 30 days before or after the sale. Understanding a wash sale: many countries' tax laws allow investors to claim a specific amount of capital losses on their taxes as an income reduction. In the U.S., you can claim up to $3,000 or your total net loss, whichever is less. If you have more than $3,000 in capital losses, you can carry the additional loss forward into the following years. The ability to carry over losses led to investors inventing a loophole where they would plan to sell a losing security and buy it again within a short period. This allowed them to claim a capital loss and use that loss to mitigate tax liabilities. To prevent the abuse of this incentive, the Internal Revenue Service (IRS) instituted the wash sale rule in the US. In the UK, the practice is known as bed and breakfasting, and the tax rules in the UK have an implementation similar to the wash sale rule. The law states that if an investor buys a security within 30 days before or after selling it, any losses made from that sale cannot be counted against reported income. This effectively removes the incentive to do a short-term wash sale. How it works generally, a wash sale has three parts. An investor notices they are in a losing position, so they close it by selling the stock or exiting a trading position. The sale allows them to take a loss that they can legally claim on their tax returns as a reduction of their earnings for that year, which reduces their total tax liability. The investor will look to purchase the security at or below the price at which they sold it. If the purchase occurred 30 days before or after the sale, it is considered a wash sale, and the loss cannot be claimed. Day traders, especially pattern day traders, those that execute more than 4-day trades over a 5-day period in a margin account, may encounter wash sales regularly. The wash sale rule still applies to these traders. The tax implications for day traders are complex, so it's best to consult a tax professional if you're day trading. Wash sale example: assume an investor has a $15,000 capital gain from the sale of ABC stock. They fall in the highest tax bracket and must pay a 20% capital gains tax of $3,000. But let's say they sold XYZ security for a loss of $7,000. The net capital gain for tax purposes would be $15,000 minus $7,000 equals $8,000, which means they'll have to pay only $1,600 in capital gains tax. Notice how the realized loss on XYZ reduces the gain on ABC, reducing the investor's tax bill. However, if the investor repurchases XYZ stock, or a stock substantially identical to XYZ, within 30 days of the sale, the above transaction is counted as a wash sale, and the loss is not allowed to offset any gains. Special considerations: the IRS does not ordinarily consider bonds and preferred stock of an issuing company to be substantially identical to the company's common stock. However, there may be circumstances where preferred stock, for example, may be considered substantially identical to the common stock. This would be the case if the preferred stock is convertible into common stock without any restriction, has the same voting rights as the common stock, and trades at a price close to the conversion ratio. Per Revenue Ruling 2008-5, IRA transactions can also trigger the wash sale rule. If shares are sold in a non-retirement account, and substantially identical shares are purchased in an IRA within 30 days, the investor cannot claim tax losses for the sale, nor is the basis in the individual's IRA increased. Reporting a wash sale loss: the good news is that any loss realized on a wash sale is not entirely lost. Instead, the loss can be applied to the cost basis of the most recently purchased substantially identical security. Not only does this addition increase the cost basis of the purchased securities, but it also reduces the size of any future taxable gains as a result. Thus, the investor still receives credit for those losses, but at a later time. Also, the holding period of the wash sale securities is added to the holding period of the repurchased securities, which increases an investor's odds of qualifying for the 15% favorable tax rate on long-term capital gains. Are wash sales illegal? A wash sale is not illegal. There is no wording that states you cannot sell a security and purchase a substantially similar one 30 days before or after the sale. The rule only makes it so you can't claim a loss on the sale in that year's tax filing. Is a wash sale 30 or 60 days? A wash sale is a 60-day window, from 30 days before the sale to 30 days after the sale. How do I avoid a wash sale? If you have sold or intend to sell a security at a loss, you can avoid triggering the wash sale rule by purchasing a similar instrument 31 days or more before or after the sale. Correction, October 14, 2022. A previous version of this article misleadingly stated that a wash sale occurred when selling a security at a loss for a tax benefit. It also incorrectly stated that an investor could not purchase the same or similar security within the 60-day window of 30 days before or 30 days after selling it.
Okay, let's very quickly talk about the wash sale rule so that you can position trade appropriately, and also this is why we probably saw most of the tax loss selling abating. I will put this article of Investopedia in the description box below. we can see what is the wash sale rule. Well, it's an IRS rule that prevents a taxpayer from taking a tax deduction if you, within 30 days before or after the sale, buy a substantially identical stock that you sold to then deduct from taxes. And by substantially identical, you'll see in further details that it doesn't necessarily have to be the exact same stock. It could be an ETF or a mutual fund or something that holds that stock. So you have to be careful if you want to take a tax loss due to stock you purchase. It's at a loss. You want to deduct that from your taxes. You cannot buy that stock back or something that contains that stock within 30 days after your sale. So again, in terms of why do we see most of this tax loss selling abate, is because any fund manager that may want to buy the stock back because it has the potential to outperform next year needed to sell, give themselves 30 days, which is going to go into the middle of January, to be able to buy it back. So again, that's part of, I believe, that causes this Santa rally, is everyone has done all their tax loss selling, it stops, and they have to wait 30 days to buy it back. Because what we'll see, we'll talk about this more next year, is your underperformers from this year have a tendency to outperform next year. So there's some desire to buy back those underperformers, but you have to wait 30 days. So again, I'll leave this article in the description box. You can read it in more detail, but here's some of the key takeaways. A wash sale occurs if you sell or trade a security at a loss within 30 days before or after you buy it back, or one that's similar, and essentially then you can't deduct it from your taxes. If you don't wait the 30 days, it's considered a wash sale. You cannot deduct it from your taxes. So that's the net of the wash sale. Again, I'll let you read that in more detail. I also am going to include another article from Interactive Brokers that I thought was very useful. I'll put the link to this one in the description box below as well. Again, you can read the details. They've got a good explanation, but the reason I wanted to include this one as well is it has a nice graphic that shows an example of, okay, if I bought this stock in January 1st, I sold it on April 1st, if I buy it back on the 10th, it's a wash sale. If I wait till July, it's not a wash sale. So again, I thought this was a useful example to show you how a wash sale would occur or not occur. And again, if you get stuck in a wash sale, you cannot deduct it from your taxes. If it's not a wash sale, then you can deduct it from your taxes as a tax loss for this year. So again, I'll leave both the links to this in the description box, and I hope that this all helps you understand both the wash sale rule and avoid it if you're trying to take a tax loss, and also understand why we expect most of the tax loss selling to have abated at this point.
Wash sales. A wash sale occurs when you sell or trade securities at a loss and within 30 days before or after the sale you buy substantially identical securities, acquire substantially identical securities in a fully taxable trade, or acquire a contract or option to buy substantially identical securities. Internal Revenue Service rules prohibit you from deducting losses related to wash sales. For more information about wash sales, read IRS Publication 550, Investment Income and Expenses, including capital gains and losses. Can IRA transactions trigger the wash sale rule? If you sell stock at a loss, you should be able to use the loss to offset gains on your income taxes, right? Right, except if you violate the wash sale rule, which states that if you bought and sold the same investment for a loss within a 30-day period, then the loss cannot be used to offset gains. However, you are allowed to add the loss to the cost of the securities that you repurchase, thereby increasing the basis. This issue becomes more complicated if you repurchase the securities in your IRA. Does that also increase the basis in your IRA? In 2008, the Internal Revenue Service addressed this long unanswered question. Key takeaways. Wash sale rules say that if you bought and sold the same security for a loss within a 30-day period, you can't use the loss to offset gains on your tax return. Wash sale rules apply to a number of financial issues, namely, stocks, bonds, mutual funds, and options. If a security is sold in a non-retirement account at a loss, then an identical investment is bought in an IRA. The result is a wash sale. When in doubt, consult a tax professional to ensure all tax strategies are being maximized for you and, if applicable, for your spouse. What is a wash sale? Let's start by defining a wash sale, which occurs when you sell shares of a stock and repurchase or acquire the same stock within 30 days, before or after, of the sale. Wash sales create the illusion of a change in holdings. As such, the IRS enforces the rule to prevent investors from claiming a tax deduction on a loss on property that they still own. Any loss from the wash sale cannot be used to offset gains on your taxes for the year. Let's look at some examples. Example, wash sale: you own 100 shares of XYZ with a basis of $2,000. You sell 100 shares of XYZ on March 21 for $1,000. You buy 100 shares of XYZ on March 22 for $600. This is a wash sale and you cannot deduct the loss of $1,000. However, you can add the loss of $1,000 to the new purchase price of $600, creating a basis of $1,600. Example, no wash sale: you own 100 shares of XYZ with a basis of $2,000. You sell 100 shares of XYZ on March 21 for $1,000. You buy 100 shares of XYZ on June 2 at the market price. This is not a wash sale because the purchase did not occur within 30 days of the sale. A wash sale can occur with other securities, such as bonds, mutual funds, and options. For example, options are considered substantially identical to the stock they reflect, so selling options on a stock you own could trigger a wash sale. Because a mutual fund exchange is technically a sell and a buy, if you exchanged into the same fund you previously sold within 30 days, that's also a wash sale. Does the rule apply to IRAs? In 2008, the IRS issued Revenue Ruling 2008-5, in which it addressed the question of whether the wash sale rules apply to IRAs. In the ruling, the IRS explained that when shares are sold in a non-retirement account and substantially identical shares are purchased in an IRA within 30 days, the investor cannot claim tax losses for the sale, and the basis in the individual's IRA is not increased. Example, claiming tax losses in an IRA: suppose that you own 100 shares of YYY stock with a basis of $1,000 in your brokerage account. You sell the 100 shares of YYY at a loss, for $400 on October 10. On November 1, you buy 100 shares of YYY stock in your IRA account for $800. According to Revenue Ruling 2008-5, you cannot deduct the $600 loss on the sale, and you cannot increase the basis of the stock purchased in your IRA by the $200 difference between the sell and repurchase. IRS Revenue Ruling 2008-5 prevents investors from using the cloak of a tax-deferred account type such as an IRA to circumvent the wash sale rule. It applies to traditional and Roth IRAs, regardless of whether the IRAs are held at different financial institutions. What happens if you break the rule? You may have executed the wash sale to decrease your current taxes, but by breaking the rule, you've only deferred the taxes and you may have to pay the early distribution penalty on the amount. For example, let's say you're ready to take a distribution from your traditional IRA. You sell stocks previously purchased in a wash sale and withdraw the proceeds. Normally, the portion of the distribution considered part of your basis is not taxable. Since your purchase in the wash sale did not increase your basis, the total value of the proceeds from those shares is taxable when distributed from your IRA. The same rule applies to non-qualified distributions from a Roth IRA in that the wash sale does not increase the basis in the Roth IRA. Example, IRA wash sale: suppose that you own 100 shares of stock with a basis of $3,000. You sell the shares for $1,500, for a loss of $1,500. Within 30 days, you purchase 100 shares of the same stock for $1,000, a wash sale, in your traditional IRA, basis equals $0. You sell those 100 shares for $2,000 and withdraw the proceeds, taxable amount equals $2,000. If you had sold the shares for $800, the taxable amount would be $800. An IRS audit can result in fines, so if you feel you have violated the wash sale rules in the past, contact a tax professional because you might want to amend previous tax returns. How to avoid violating the rule? You can ensure that you do not violate the wash sale rule by following some simple guidelines. View all investments as a single portfolio, regardless of the account type. Plan tax-related transactions based on your entire portfolio. This will help you recognize when a wash sale might occur. Sell stock at a loss more than 30 days before or after purchase to claim tax benefits. To maintain your asset allocation strategy, buy a different stock in the same category, for example, a different utility stock. You want to make sure that the stocks cannot be categorized as substantially identical. Use a set investment plan or method. Having performance goals for each investment and a contingency strategy keeps you focused on making well-conceived investment decisions as opposed to arbitrary trades. Invest in volatile investments outside of IRAs and other tax-deferred accounts. This will allow you to take advantage of tax benefits by changes in taxable gains and losses. Buy investments that pay dividends and interest inside an IRA. You will be able to maximize the tax deferral of income and reinvest it in your retirement fund. Use automatic dollar cost averaging or automatic liquidations for withdrawals from your IRA. Don't purchase these same investments in other accounts. Don't implement options strategies based on stocks. Use stock matching on a first-in, first-out basis to determine whether you are in danger of violating the wash sale rule. If you own a stock that took a big dip and you can't stand the fall, sell it. If it's a dog, there's no need to buy it back, no matter how low the price. The bottom line: the wash sale rule applies to all investment accounts you own or control, including your spouse's account. Be sure to keep the lines of communication open between you and your spouse about trades in your portfolios for this exact reason. When in doubt, consult with a competent tax professional to ensure that the proper and most effective tax strategies are applied to your investments. Can I sell a stock and then buy it again within 30 days? Absolutely. You just can't sell a stock, buy it again within 30 days, and then claim the loss incurred in the sale to offset your capital gains taxes due. IRS rules allow taxpayers to deduct capital losses from the amount of capital gains taxes they owe. As a result, many investors employ a strategy called tax loss harvesting. Towards the end of the year, they may sell a poor-performing stock and take the loss. They'll at least be able to use that loss to offset the taxes due on the sale of their best-performing stocks. That's fine with the IRS as long as that investor doesn't buy the same stock again right away. That would imply that the investor hopes to profit from a temporary loss but then erase it with future gains in the same investment. What triggers the wash sale rule? The wash sale rule decrees that an investor cannot sell an investment at a loss, repurchase a substantially identical investment in 30 days or less, and then use the loss to offset the taxes owed on capital gains. The purpose of this IRS rule is to prevent taxpayers from claiming artificial losses. What is the penalty for violating the wash sale rule? First, the deduction will be disallowed and the investor will have to pay the capital gains that would have been due if it had not been used. The loss will then be added to the cost basis of the repurchased investment. The IRS will also add the holding period from the first transaction to the holding period of the later transaction. How to avoid violating wash sale rules when realizing tax losses. Tax loss selling is an investment strategy that can help an investor reduce their taxable income for a given tax year. Tax loss selling involves selling a security that has experienced a capital loss in order to report it as a capital loss when filing yearly income taxes, and thus lower or eliminate any capital gain that may be realized by other investments. In order to successfully realize the loss for tax purposes, you have to take the step of liquidating the position during the tax year. Any unrealized loss on an investment cannot be deducted from your income taxes. Sometimes an investor will decide to replace that security with a similar security, allowing them to maintain a consistent, optimal asset allocation and achieve their desired returns. If you take this approach, it is important to be mindful that you do not accidentally trigger a wash sale in your investment account. Key takeaways: wash sale rules prohibit investors from selling a security at a loss, buying the same security again, and then realizing those tax losses through a reduction in capital gains taxes. Tax loss selling is an investment strategy that can help an investor reduce their taxable income for a given tax year. Investors may be able to claim up to $3,000 in capital losses per year in order to offset their taxable income, if they are married filing jointly. A common strategy for avoiding violating the wash sale rule is to sell an investment and buy something with similar exposure. What is a wash sale? A wash sale occurs when you sell or trade stock or securities at a loss and within 30 days of the sale, either before or after, you purchase the same, or a substantially identical, investment. The wash sale rule is a regulation established by the Internal Revenue Service (IRS) in order to prevent taxpayers from being able to claim artificial losses in order to maximize their tax benefits. When a wash sale occurs in a non-qualified account, the transaction is flagged and the loss is added to the cost basis of the new, substantially identical, investment you purchased. If you continue to trade the same investment, the loss gets carried forward with each transaction until the position has been fully liquidated for more than 30 days. The same rules apply if the spouse of the individual that sells the security, or a company controlled by that individual, purchases the same or substantially equivalent securities within the 30-day timeframe. In addition, your holding period for the new stock or securities for designating whether or not the investment will represent a short or long-term capital gain includes the holding period of the stock or securities that were previously sold. Investments subject to wash sale rules. The wash sale rule applies to stocks or securities in non-qualified brokerage accounts and individual retirement accounts (IRAs). The sale of options at a loss and the reacquisition of identical options within a 30-day timeframe would also violate the wash sale rule. The IRS provides guidelines about what is considered a substantially identical investment and thus may trigger a wash sale violation. In IRS Publication 550, entitled Investment Income and Expenses, including capital gains and losses. A substantially identical investment can include both new and old securities issued by a corporation that has undergone reorganization, or convertible securities and common stock of the same company. When an investor holds several different investment accounts, wash sale rules apply to the investor, rather than to a specific account. The IRS requires that brokers track and report any sales of the same CUSIP number in the same non-qualified account. However, investors are responsible for tracking and reporting any sales that occur in all other accounts that they control, including any accounts belonging to their spouse. Offset capital gains through tax loss selling. While some investors turn their attention to tax loss selling towards the end of the calendar year, it is possible to use this strategy throughout the year to capture tax losses through rebalancing or replacing positions in your portfolio. Capital losses are used first to offset other taxable capital gains. After this, up to $3,000 per year can be used to offset other taxable income for an individual filer or married couple filing jointly, up to $1,500 for married filing individually. For example, if an investor realizes $5,500 in long-term losses during the year, at the time that they file their income taxes, they can use $2,000 of those losses to offset the taxes on other capital gains and $3,000 to offset the taxes on their ordinary income. If this investor's long-term capital gains tax rate is 20% based on their income and their effective federal income tax rate is 25%, using this strategy the $5,500 loss can be reduced by $1,150, depending on the state they live in. The investor may also be eligible for a reduction in their state taxes. The remaining $500 in capital losses can be carried forward to future tax years. Unfortunately, losses cannot be transferred at death. Strategies for avoiding wash sales. There are strategies for avoiding wash sales while still taking advantage of taxable gains and losses. If you own an individual stock that experienced a loss, you can avoid a wash sale by making an additional purchase of the stock and then waiting 31 days to sell those shares that have a loss. A potential drawback of this strategy is that it can increase your market exposure to a given sector and could potentially increase your risk. In this same situation, an investor may decide to liquidate the holding, recognize the loss, and then immediately buy a similar investment that will also satisfy their investment goals or portfolio allocation. For example, an investor may decide to sell their stock of the Coca-Cola Company (Co.) and then immediately purchase a similar investment of PepsiCo, Inc. (PEP). Similarly, an investor may decide to sell their shares of the Vanguard 500 Index Fund (VFIAX) and replace them by purchasing shares of the Vanguard Total Stock Market ETF (VTI). Correction: January 20, 2022. The offset amount for individual taxpayers was incorrectly specified in a previous version of this article. How taxpayers can do a legal wash sale. The ability of taxpayers to deduct investment losses against capital gains can encourage many to realize losses on their stocks and securities at the end of a tax year. Taxpayers must be careful that they are not participating in wash sales when making adjustments to their portfolios, or they may find their deductions disallowed. Wash sales. It's all about staying clean. If an investor wishes to liquidate a security and realize a loss in order to deduct it against capital gains, that investor must make sure that they are washing their portfolio clean of that position and not adding in a substantially identical position within 30 days before or after the sale. According to the U.S. Securities and Exchange Commission, if a taxpayer buys an identical stock or security within the 30 days before or after the sale that creates the loss, then the loss is not deductible. Additionally, if the taxpayer buys a contract or option on an identical security within that same period, then their loss will not be deductible. IRS Publication 550 states that, in order to avoid triggering the wash sale, an investor must also avoid buying a substantially identical position inside of their traditional or Roth IRA. This is an important note because, generally speaking, losses within an IRA are confined to the IRA and cannot be deducted against capital gains, except in special circumstances. Investors who understand this may believe that wash sale rules would not apply if the substantially similar stock is sold from an account that is not an IRA and repurchased inside an IRA, but that would be incorrect. There are other outlying circumstances that can trigger the wash sale rule. If a spouse or corporation under the investor's control purchases a substantially identical security during the 30 days before or after the sale, that can trigger the wash sale. It doesn't always require an actual purchase to disallow a loss deduction. Employees who are given shares of corporate stock as a bonus may not be able to deduct losses if they receive additional bonuses within the 30 days surrounding the sale. It's even possible that some mutual fund purchases may run afoul of the wash sale rules. Funds that are modeled after the same index could be considered substantially identical, even if the fund family isn't. When a deduction is disallowed, IRS Publication 550 states that a disallowed loss will be added to the cost basis of the new security. This will essentially offset gains later and may even create losses upon the security's future sale. In addition, for capital gains purposes, the holding period for the new security will include that of the security sold. The concept of substantial identicalness. If you wish to avoid triggering the wash sale rule, it's important to understand what the IRS sees as substantially identical. Examples given in Publication 550 include a corporation that reorganizes and has a successor. In that case, the securities of both organizations could be considered substantially identical. Another example given is the preferred stock that is convertible into common stock. Working around the wash sale rule, there are a couple of acceptable workarounds that could help you maintain all or part of your deduction while purchasing substantially identical securities. The first is that a partial deduction can be taken if more stock is sold then repurchased within the 61 days surrounding the sale. For example, if you own 1,000 shares of XYZ and you sell them all at a loss then repurchase 200 shares, you may still be entitled to deduct the loss of the net 800 shares sold. Since the disallowed loss and the other 200 shares will be added to the cost basis of the newly purchased 200 shares, the rest of your loss doesn't exactly disappear, it is simply delayed. Another workaround is just to purchase substantially identical shares outside of the 30-day periods before or after the sale, resulting in losses. The bottom line, the wash sale rule can result in the disallowance of a much-needed deduction. For this reason, it's imperative that you understand what is considered substantially identical, and follow the above suggestions to work around the wash sale rule.
So another area that might have caused the start of this, who poked the bear, what poked the bear this week, is it could have been the start of what's called tax loss selling or tax loss harvesting. And again, just a reminder, we've got videos coming out that will explain in more detail what that means. This was the first week within the wash sale rule 30-day window. The first day this week was December 5th. If you look at the market holiday calendar for 2023, you'll see that January 2nd is a market holiday, and therefore, this was really the first week within that 30-day window where what the wash sale is if I sell something for a tax loss, right now I cannot buy that back within 30 days or I lose the benefit of that tax deduction due to the loss in that selling that particular stock. So we may have seen a start of that kind of tax loss harvesting, tax loss selling in this first week within that 30-day window. And thank you very much, Spacula, for that super chat. Also, Ollie in the Bay, thank you very much. In Beach We Trust, thank you, Ollie. We greatly appreciate all your support. Thank you for those super chats. Thank you for all you guys do to support us. We certainly greatly appreciate it. So thank you again. So again, we're going to see more of that tax loss harvesting, tax loss selling all through the month of December, and we're going to talk about it in more detail. What does that mean? When do we see the most impact? When do we see it abating? But that's going to put selling pressure on particularly stocks that are down, significantly. And tomorrow I'll probably talk about this again in terms of stocks you're looking at buying. Is you need to be aware of this. Stocks that are down significantly are candidates for tax loss harvesting, and that will put further downward pressure on those stocks. So again, we'll talk about that more tomorrow, but I think that also may have contributed to poking the bear this week is the start of that tax loss harvesting within this 30-day window. So again, keep an eye out, keep a reminder, subscribe to our channel, hit the bell notify icon, and you'll get notified when we come out with these videos that will explain in more detail what exactly is tax loss harvesting, how does it work, how might you take advantage of it if you can, and then also how do you avoid a wash sale, which can negate the benefits of tax loss harvesting if you're not careful and you don't do this in the appropriate fashion. So also, just a reminder, please see our video about how to make money trading in December. It has more general strategies, trends, trading ideas about how to make money trading in December in general. And again, the rest of this month, we'll be talking about tax loss harvesting, the wash sale, and then we'll get into, the Santa rally theme towards the end of the month. And then we'll see, can we expect a Santa Claus rally this year? Why or why not? What exactly does that mean? And again, we'll have a more detailed video coming out about what is a Santa Claus rally? What does that mean? When does it occur, etc. And what can we expect coming out of that? Someone and maybe it was Alan, asked about tax loss selling and harvesting, and that was a point I wanted to make about your shopping list. And if you're new to our channel, concept of the shopping list is, stocks you always wanted to buy on a dip, on a good opportunity. But again, there's several caveats. These are ones that you probably want to hold, invest in for a longer period of time. Again, ones that you always want to buy and you're looking for an opportunity. It's always good to have that list of stocks ready. So if we do get a market crash or a significant dip, you know what you want to take advantage of quickly. Now, again, an important point in December, particularly in this time frame in December, is to be aware of tax loss selling and harvesting and the selling pressure that's going to put on stocks that are significantly down for this year. So if you've got a stock that's significantly down for this year, it may be vulnerable to tax loss selling or harvesting, which means whoever owns that may sell it just to take advantage of the tax loss on their taxes for this year, irregardless of whether they like the stock or not, or think it has a long-term, potential, whatever. They're going to sell it now to take advantage of the tax loss. So be careful with stocks that are significantly down for the year. In the past, we talked about cheap value stocks that are significantly down. They're close to their 52-week lows. My warning in December is to be careful with those because they potentially could significantly decline even more going into the end of December due to tax loss selling and harvesting. So again, be careful with those that are down significantly for the year at this time. Now, once we get into early January, and I'll talk about that more towards the end of the year, that changes significantly. We'll talk about how that reverses into early January. And again, I'm working on videos to explain in more detail what tax loss harvesting is, how it works. Also, what's the wash sale rule? How does that work? And then again, all this month we'll talk about the implications that has on our trading strategies. And again, I just wanted to bring it up now that be careful with your shopping list in particularly early December. Is I wouldn't buy anything that was significantly down for the year that might be vulnerable to significant tax loss selling at this time, because you can wait till the end of the month, and when it bottoms going into next year may give you a better opportunity. So I hope that helps. Again, I'll throw my financial advice banner up briefly. None of this is financial advice. It's educational purposes only, but I hope it helps. Also, we talked about tax loss selling and profit taking, which is all end of year accounting, particularly for large fund managers, hedge fund managers, etc., and institutions. There's discussion that this should wrap up the week before Christmas. However, we may get a large glut of institutional tax loss selling all at once, or profit taking. They may be waiting for an opportunity, so you might see a large volume of selling hit all at once in the next week or so. So please be aware of that. If you see, if it's a company at a loss for this year, you see a lot of volume coming in, it's going to really put downward pressure. Again, anything that's way up this year is vulnerable to companies taking their profits. Again, this is all to make their books look good, reduce their tax exposure for the end of the year. That should all wrap up, hopefully, by the week before Christmas. So let's also talk about the Santa rally. You'll hear discussion of the Santa Claus rally. We're going to talk about this in more detail next week. What is the Santa Claus rally? It's the last week of December through the first 2 trading days in January. I've got this link up to this article in Investopedia that describes the Santa Claus rally in more detail. We will review this article in more detail next week, but I just wanted to give you the reference to it and talk about preparations. So what the expectation is okay, we have downward pressure due to tax loss selling and profit taking, and then the expectation is for a Santa Claus rally the last week of December. So this tends to be a very good opportunity to buy the bottoms, is these stocks that are heavily beaten down over the next week or so, if they are good companies, not broken companies, just a broken stock, and they're of value, this is a great opportunity to fulfill your shopping list in preparation for Christmas, right? So hopefully we've got your Christmas list ready, and when you see the opportunity and these guys value stocks bottom and are preparing to turn up into the Santa Claus rally, that's your opportunity to scoop them up. So it's important this week to have your shopping list ready. Be prepared to buy those value stocks that hit bottom due to this downward pressure, and hopefully ride them up through the Santa Claus rally into the end of December and the first part of next year. So again, we'll talk about Santa Claus rally more next week, but we want you to, this week is the week to prepare and buy those things that are going to benefit from the Santa Claus rally the following week. Finally, be ready for news of further variance. If we start to hear additional variance hit the news, be prepared for the seesaw action. Please see our list of lockdown and reopening plays in the comments of the last couple weeks of game plan videos. We've also posted on our Facebook group. We expect more variants. There's no reason not to expect there won't be more variants, more seesaws of lockdown reopening reactions. So once it hits the news, expect a reaction. Also, as a bonus for viewing these weekly trading game plan videos, we've got a couple other videos that we produced and not yet premiered, not yet published yet. One's on how to prepare for trading while traveling, and another is how to use the Gartner hype cycle for your stock trading. We talked about that in a previous weekly game plan a little bit. This is a much more detailed video about how to use the hype cycle for your benefit going forward. So I'll put the links to these in the description box and potentially in the comments so that you can view them. They're unlisted right now. We'll be premiering them as we have the opportunity to do so. So we hope all this information helps you go select the stocks for your shopping list for this week, for your watch list, as we will be doing, and then please come back and join us for part 2 of this weekly game plan for December 13th through the 17th, and we'll tell you what stocks we are adding or removing from our watch list for this week, and our price targets, strategies for trading those stocks for this upcoming week. So again, we hope this all helps. Please let us know in the comments below. Feedback on this information. Was it helpful to you? How can we improve, etc.? And if you're not already subscribed, we hope you will choose to do so. If you like this type of information and it's valuable to you, please smash the like button. Help the YouTube algorithm share this with additional of your fellow traders out there. And please share this with your friends and fellow traders. We appreciate your time. Thank you for watching, and we'll talk to you again soon. That you have found our video on the wash sale rule for beginners helpful to you for your trading career. We hope that it has helped you get a better understanding of what is a wash sale, how do they work, what's the purpose of the wash sale, the details of the wash sale rule. Again, understanding the basics of wash sales and how IRA transactions can possibly trigger a wash sale rule, how to avoid violating the wash sale rules when realizing tax losses, and how taxpayers can do a legal wash sale. So we hope all of this information helps you deal with wash sales appropriately in your trading. Also benefit from these facts of how a wash sale works throughout the year to make money trading, succeed in your trading career. If you have any questions about any of this information, please feel free to put your questions or comments. Let us know what you think of all of this in the comments below this video, in our free Discord, for which you can find an invite in the description box below, also our Facebook group, or you can contact us via any of our social media sites, for which you can find links in the description box below, and also on our homepage, beachbumtrading.com, bum without the U. So again, let us know what you think of all of this information, and again, if you have any further questions that you would like us to follow up with you and try to answer for you regarding wash sales and how to trade relative to wash sales, please let us know. Again, we hope that this all helps. Thank you for watching our the wash sale rule for beginners video to the end, and we hope this helps you succeed in your trading career. Good luck and have a great trading week. Bye. The content of this video was produced by BeachBum Trading. We hope you will choose to also join us in the BeachBum Trading community and subscribe to our YouTube channel. Visit us at our homepage at beachbumtrading.com, the bum without the U. Similarly on Twitter, BeachBum Trading, bum without the U. On Facebook and in our BeachBum Trading Facebook group. Please follow us on Pinterest and on Instagram. All of the links to our social media sites will be included in the description box below, and we hope you will choose to subscribe to our BeachBum Trading YouTube channel and follow us on social media. Thank you. We also cordially want to invite you to our new BeachBum Trading Community Discord server, where we can have discussions on all topics related to trading, success in trading, investing, etc. You can see alerts when we make trades, changes to our watch lists, etc. So again, please join us in the new BeachBum Trading Community Discord server. You should be able to find a link in the description box below. You can also find a link in the social media category on our webpage, beachbumtrading.com, without the bum without the U, and also in the link section on the About page of our YouTube channel, etc. So again, we look forward to seeing you in the BeachBum Trading Community Discord server soon. Wave and say hello. BeachBum Trading also now has a site on Patreon. If you are willing and able to help support our efforts to produce all the content and help you achieve the financial freedom you want, deserve, to be able to live the BeachBum lifestyle or any other kind of lifestyle you would like, and you're willing and able to help support our efforts in these regards, we hope you'll choose to visit our Patreon page. You can get access to our new BeachBum Trading Community Discord server, which is currently under construction, but you will get access to the Discord server by supporting us through Patreon. Again, this is all currently under construction, but you can see we just have the default levels, membership levels, but again, each level allows support, allows access to our Discord. We're also posting our trade positions initially in our Discord, and again, we greatly appreciate any support that you're willing and able to provide. So thank you for your consideration. Another way that you can help support BeachBum Trading and being able to produce frequent quality content for you for free on YouTube, etc., is in addition to subscribing to our BeachBum Trading channel, hitting the like button on our videos, and hitting the notify so you're alerted when we release further videos. You can also choose to show your support for BeachBum Trading with a super thanks, which you can find below this video. If you hit the heart with the $sign, the super thanks, again, you can financially support BeachBum Trading in whatever amount that you wish, and we greatly appreciate your support, and that will help us, again, be able to produce frequent quality content that we can provide for you and all your fellow BeachBum traders around the world for free on YouTube. So again, we greatly appreciate all of your support, and thank you very much. Thank you again for watching our video. We hope that you liked it. If so, please smash the like button, give us a thumbs up. If you're not already subscribed, please consider subscribing to our BeachBum Trading YouTube channel. Please share this video with your fellow traders and friends. And please give us your feedback and any recommendations for improvement in the comments section below. And let us know what else we can do to help you in your trading career. Thank you again, good luck, and have a great trading day. If you like this video, we hope you will choose to subscribe to our YouTube channel by clicking on the box in the upper left-hand corner. You can watch another video like this by clicking on the box in the lower right-hand corner. And we have a whole playlist of videos like this that you can access via the box in the upper right-hand corner. Our latest video is available in the box in the lower left-hand corner. We hope you like this and have a great day.